All right, welcome everybody. So thank you so much for joining us today. I'm Jake Alexander. I'm going to be your host for today's event, webinar series, which is the top 5 tax planning tips of the summer. Really excited to dive into this stuff and spend a little bit of time with you guys here today. Before we get too far into everything, I like to just do a little bit of sort of housekeeping tips in the beginning. First of all, tell you all thank you for taking time out of your day to join us. We really appreciate it. But then also say it's whenever we do these events, we typically have pretty good attendance, but it's usually somewhat of a mixed bag of attendees where some of you may already be existing clients of ours who are working on some of these tax planning strategies with us already. If that's the case, we really appreciate you being here. I love the fact that you're here to learn more about this kind of stuff. Some of you may be potential clients who we aren't working with already and you just want to learn more about this stuff. That's amazing too. Other times we have referral partners, vendors, and sometimes even employees of our company on here we have for training purposes and other things like that too. I say all that to say, ask as many questions as possible. There's no such thing as a silly question. There's people from all sort of different demographics here and backgrounds. Some of you may be employees, some of you may be business owners. A lot of this stuff is more so gauged towards business owners, but if you are just an employee, that's totally fine as well. And so I say all that to say there's no such thing as a silly question. If you see on the bottom there should be a Q&A box. If you do have questions as we go along, type them in there. We have time built in at the end of this specifically for Q&A, so we will get to all of those questions before the webinar is over, or just depending on the nature of the question, we may answer it as they come up in the conversation too. So no such thing as a silly question. Type some things in there, Q&A questions as they come up. We would love to answer those. And we love for these to be as interactive as possible. I find it creates for a better learning environment for everybody. There could be people on here who have questions, maybe just don't necessarily know how to articulate them the best. And if it's a question that you have, I would encourage you to put it in there because I would almost assume somebody else has the same question, and it creates a really good learning environment where everybody can learn together. So just a little bit of housekeeping before we jump into it. What we're going to cover today, our agenda of events here. Want to do just a quick introduction. Jake Alexander, Action Accounting is the name of our business. This presentation isn't about me per se, but I always think it's nice that I'm not some perfect stranger up here talking to you guys. So we'll just do a quick introduction about me and the company. Second thing is we're going to talk about the difference between being an employee and a business owner, because there's a major difference between the two when it comes to tax purposes. Ever since 2018, when they came out with the Tax Cuts and Jobs Act, it greatly changed the ability for employees to be able to take advantage of any sort of strategic tax deductions. And so I want to dive into that just a little bit because kind of like I was saying earlier, a lot of times we have different people from different backgrounds on here. Some people may be employees, business owners. I want to highlight just the difference between the two really quick. Then we are going to jump into the top 5 tax tips, tax planning tips of the summer. We're going to talk about the strategy itself. We're going to talk a little bit about the implementation of these strategies. And then most importantly, some of the documentation that's necessary if you want to take advantage of these strategies, because there's a lot of stuff out there on social media and the internet and this and that of how great and easy these strategies are. While some of them are, others can be pretty tricky. The most important part is you want to implement them correctly. And most importantly, you want to have the right documentation to substantiate the strategy if it ever were to get questioned by the IRS. And so we're going to spend some time on that. And then last but certainly not least, we've got built-in time for Q&A at the end. So type your questions in as we go. Like I said, some of them we may pick out and answer. Others we may save to the end, but utilize that Q&A box down there when questions do come up. And so real quick introduction to me, I'm Jake Alexander. I'm the owner of Action Accounting. We are a full service accounting firm with 3 main departments, or 3 main services, if you will. We have our bookkeeping department, which they're responsible for creating financials for business owners. Most importantly is like a profit and loss statement. As a business owner, I can't tell you how important it is to understand how much revenue is coming into your business, how that revenue is coming into your business, how much money you're spending on items, and then most importantly, what's your net profit? What are you actually left with at the end of each month, and then at the end of the year, of course. And so we have a bookkeeping department where all they do is prepare financials for our business owner clients, and most importantly, help them understand how to read them and teach them things about their business so they can make better business decisions going forward, understand their cash flow, all sorts of different things in that realm. And so our second department is our tax preparation department, which they're responsible for filing timely and compliant tax returns for businesses and for the individuals who owns those businesses in a timely manner. And so a lot of people are familiar with tax preparation because that's basically filing your taxes every year. There's certain dates when they have to be filed by that the IRS issues every year. If you want to, you can do an extension on those dates and wait till the end of the year. Well, I'm here to tell you that's not really where the magic happens, because just the function of how tax preparation is built, you're filing your taxes this year in 2024. And if you did an extension, you're waiting all the way to the end of 2024 for activity that's happened back in 2023. And so there's only so much that we can do to actually save money. In reality, there's not a lot we can do to save you money when we're working retroactively. The main goal, and the reason all of you are here learning more and more about these strategies, is because we're doing tax planning. And this is by far my favorite service that we offer. Our favorite department is tax planning. That's what we're doing right now. That's proactively working with people who are earning great amounts of income, who need proactive strategies to pay the least amount of taxes as possible. And so that's the way true tax savings really works. It's to start now in the summertime, planning for 2024 and moving forward. And so I always like to highlight the difference just between the few departments that we do have. Our website's actionaccountingusa.com. You can always go there if you need to reach out to us or contact or anything like that. And then, of course, follow us on social media. We always enjoy all that stuff too. We're on all the popular platforms there. So I like to start in the vein of tax planning. I like to start this off with a quote. So this is a quote from Judge Billings Learned Hand, who was a judge of the United States Court of Appeals. And this was an official court opinion that was issued. This is a quote from him. This is almost 100 years ago. This is from 1934 and it still holds true to this day. He said, "Anyone may so arrange his affairs so that his taxes shall be as low as possible. He's not bound to choose the pattern which best pays the treasury. There's not even a patriotic duty to increase one's taxes." And so to me, it's very interesting. What that means is that it's okay to have a proactive strategy to pay the least amount of money in taxes as possible. There's no patriotic duty to paying more taxes. You don't have to choose the pattern which best suits the treasury. We can choose the pattern that best suits us and our clients as taxpayers. And so I always love to start with that. If you're on this webinar, you're obviously interested in saving money on taxes, and that's exactly what we help our clients do. And so to me, understanding a little bit, like I said, the difference between employees and business owners and what the tax code really is and who it's really written for is it's written for business owners. And why is that? It's because 2/3 of new jobs in the United States are created by small business owners. 40% of all economic activity is attributed to small business. And the government understands this. The Internal Revenue Service understands this. It's small businesses that are the lifeblood, the backbone of our country, essentially. And so the IRS incentivizes business owners to reinvest money into their business and gives them tax incentives for doing so, because they know that creates more jobs, which creates more tax revenue, and it just continues things going. And so understanding that is really the key to the beginning of this process, in my opinion. Also understanding what is the IRS, right? It's the Internal Revenue Service. At the end of the day, they're debt collectors is what it is. They're a debt collection agency. Tell our clients their job is to collect money from taxpayers. Your job is to minimize the amount that you give them. And so the IRS being a debt collection agency, they're the biggest, most powerful one in the world. So you don't want to mess with them, obviously, but that's their job. Their job is to collect tax revenue from taxpayers, and they're very good at it. And so you might be asking yourself at this point, what if I'm not a business owner? What if I'm just an employee? I wanted to cover that really quick for a minute to just kind of outline a few things. And so if you are an employee, there's nothing in the tax code that says you can't start a business. You can always start a business. What's interesting about that is the IRS states that a business to not be reclassified as a hobby has to show a profit for 3 out of 5 years. Well, what does that mean? That means for 2 out of 5 years, said business could show a loss. That if you're a high earning W-2 employee that has withholdings from their paycheck on a regular basis over here, that now shows a loss on a legitimate business over here, that's going to lower the overall tax liability owed, and at the end of the day, save you money on taxes. And so this doesn't mean that you need to change the way you earn income. If you have a W-2 job that's working out great, by no means do we want you to stop doing that to go try to start some new side business. But if we can incorporate some business activity over here, that we can start to incorporate business expenses to offset that income, at the end of the day, that's the name of the game right there. And so if you don't want to start a business, that's totally fine. Just keep in mind, kind of like I was saying earlier, since 2018, when they did the Tax Cuts and Jobs Act, they got rid of, they were called unreimbursed employee expenses, which used to give employees the ability to write off deductions for meals and travel and vehicle expenses and all that sort of stuff. All that stuff went away years ago. And so if you are an employee, you're not interested in starting a business, that's fine. I would encourage you to maximize any and all employer benefits that are offered at the place you're working in. So those are things like retirement plan contributions. A lot of people working for big companies don't realize they can actually max out their 401k contributions. You can put over $20,000 per year into those plans. It just doesn't have to be the little, 3% matching or whatever it is when you first sign up. You can do a good amount of money into those, and that's money that you're saving taxes on. You can set up an HSA, which is a health savings account, if applicable. You got to have a certain kind of health insurance plan to qualify, and there's some stipulations, but those can be great if you're an employee. Then if you're a high W-2 earning employee, earning multiple 6 figures, you might want to look at like a deferred compensation plan. A lot of bigger companies will offer those to higher compensated employees, where you can start to defer payouts on compensation into later years, which will just in turn give us more time to come up with strategies to save you money on taxes on that income. So that's a little bit about employees. Moving over to more of the business owner sector, these are our tax tips. And I saw we had a few more people join in there too, just to kind of, not to ever start back over from the beginning, but some housekeeping tips. We got our little Q&A box down there in the bottom. So if you have any questions that pop up, feel free to pop those in there. We've got time built in at the end for more Q&A too. So if something comes up, you have any questions, want us to clarify or anything like that, feel free to type in the Q&A as we go. And so moving along, if we go into the top 5 tax planning tips of the summer, what I want to do here is really just cover them at a high level. Then we're going to spend some time diving into each strategy, kind of like I was saying a few minutes ago, where we talked a little bit about the implementation, some of the reasoning behind it, and then most importantly, the documentation you would need if you did want to implement these strategies. And so a real high level, first one's retirement plan. As a business owner, in my opinion, you absolutely need to have some sort of retirement plan set up. We're going to cover 3 of the most common ones. There's a lot of them out there. These 3, in my opinion, are the most common and typically the most applicable. So we're going to spend a few minutes on that. Second one is depreciation. We say this is the Lord's gift to tax professionals and business owners is depreciation. There's a section in the Internal Revenue Code called 179. We're going to dive into, talk about ways to incorporate asset purchases into your tax strategy, which can be very beneficial. Third one's the Augusta rule. This is a fun one right here. We're going to talk about how to create some tax-free rental income. Specifically, if you're a business owner, this is a great strategy you want to be aware of. Hire your children. This is another one as well. It gets a lot of attention. We typically get a lot of questions on here. I tell our clients, you never want to pay your children an allowance, but you want to give them a job as soon as humanly possible. And the last one, maybe not the most fun to talk about, but this is good, clean records. We're going to talk about some best practices and ways to stay organized so you can keep all this stuff nice and tidy, where in the event, if it ever was to get questioned by the IRS, we have all of our documentation in order and we can substantiate our position, because that is very, very important. So those are the 5 tips right there. We're going to dive into each one separately. For retirement plans, the first one I'll talk about is a traditional IRA. So if you're a business owner, you absolutely need to have a tax deferred retirement plan set up of some form or fashion. And we're just going to talk about 3 here. I mean, there's several more than this that we could get into, but for the sake of time and keeping everything high level, I just wanted to highlight these 3 right here. So a traditional IRA, this is the easiest to set up from a compliance standpoint and from just an overall maintenance standpoint. A lot of people don't realize you can have a traditional IRA. You can put $7,000 in there in 2024. That's money that's now deferred from you paying taxes on. If you're over 50, you can actually put $8,000 in there. With a traditional IRA, that's, like I said, the easiest, typically most simple to set up. So in the beginning, if you're just starting your business, you want to look at something like that. As your business starts to become more successful, you might want to look at a SEP IRA, which stands for a Simplified Employee Pension Plan. And this is where things can get pretty interesting right here. A lot of business owners don't understand how much money you can actually get into these plans. And with a SEP IRA, the limits for 2024 is $69,000. And so your business needs to be generating a good amount of income. I would say at least over 6 figures in profit for this to start to make sense. But if it is, you can deposit good amounts of income into these accounts, and then that's money that that's money that's now a deduction from your business and personal side, and it's now in a retirement account growing tax deferred for you. And so with a SEP IRA, there's certain limitations and there's certain milestones you have to hit from an income perspective and from a salary perspective from the owner. But once the business is successful enough to substantiate it, that could be a really great way to go right there. There's also a solo 401k plan, which a lot of people are unfamiliar with. This is really for husband and wife owners of businesses that don't have any other employees. This could be a phenomenal plan for them right here. The limit is the same as the SEP IRA. It's at $69,000, but it can actually apply to the husband and to the wife. So if you look at a situation like that, if it's the right situation and it makes sense, put over almost $140,000 into these retirement plans. And this is every year. So imagine the compounding effect. This money you're not paying taxes on, and it's now in a tax deferred retirement plan working for you. So for all of these plans, you have to use a qualified intermediary to set it up, and they're going to provide you with all of the documentation necessary. The most important part about these things is we start working on them now. Some of them we can squeak in the contributions before the tax deadline next year, but we want to have the plan in place. We want to have the strategy in place this year. So we're not hustling around at the last minute, scrambling, trying to get these things set up or to get them to qualify properly. You want to make sure you do it well in advance. If you have questions, you can type down in the Q&A box there. You can type retirement plan. I'll have somebody from our team follow up with you on that specifically, but we wanted to highlight those right there. If you're a business owner, you absolutely want to have some sort of retirement plan set up and in place. The next one is depreciation. So there's this code, this section of the Internal Revenue Code, Title 179. And what it allows for is for business owners to depreciate, which is a fancy term for write off, a large amount of the full price of assets they purchase for the business, whether or not you are still making payments on the asset or not. And so the most commonly known use of this deduction right here is when it comes to vehicles. And so if you have a vehicle that you use for your business, and I say this too, the vehicle doesn't need to be titled under the business. You don't need to have commercial insurance. This can be a vehicle that you buy in your personal name, but as long as it's used by the business 50% or more of the time, and it weighs over 6,000 pounds, it may qualify for Section 179, which what Section 179 says is we can depreciate up to 60% in 2024, the full value of that vehicle. And so for an easy example, if you were to purchase a $50,000 vehicle Doesn't need to be purchased under the LLC or under the business name. You don't need to have commercial insurance. You can purchase it under your personal name as long as it's used for more than 50% of the time or more for business, and it weighs over the 6,000 pounds. You could take up to 60% of the full value of that as a deduction in the first year. And so this, for depreciation specifically for Section 179, this was one of the major changes they made back in 2018 when they did that Tax Cuts and Jobs Act that I was referencing earlier. And so as of right now, Section 179 is set to expire at the end of 2026. It's on what's called a sunset period, where it's, as long as there's no changes, which I would find it highly hard to believe with an election looming and new whoever ends up coming in to office, that they don't make changes to this. But as of right now, it's set to expire at the end of 2026. It's on what's called a sunset period. So would go 60% in 2024, down to 40% in 2025, and 20% in 2026. Like I said, I would be shocked if they didn't repeal that and renew it and make some sort of changes. But as of right now, it is set to expire. So as a business owner, you want to take advantage of purchasing assets for your business. Most popularly is the vehicles, but this also applies to things like desks, computers, electronics, any sort of assets you're purchasing for your business. We want to make sure you get the full deduction for those as fast as possible. And that really plays into our tax strategy. Next one's the Augusta rule. This is a fairly popular one right here. This is Internal Revenue Code Section 280A, states that if you own your home, you can rent it out for up to 14 days per year. The income derived from that activity is tax-free. You don't have to pay taxes on it. And so where this came from is actually residents of Augusta, Georgia. Every year when the Fancy Masters golf tournament would come into town, these people had the opportunity to rent out their houses, these nice big houses that are right on the course, for exorbitant amounts of income, but it was only a short period of time. So they actually lobbied to Congress to get the IRS to approve Internal Revenue Code Section 280A. That's why it's nicknamed the Augusta Rule. And so there's a lot of different ways this can work. The most popular way is, if you own your home, you can rent it out. So you can use a service like Airbnb or VRBO. If you happen to live at Augusta National Golf Course, that's like the most popular example. If not, if you live in a popular vacation area, we're here in the Tampa Bay, Florida area, you know, minutes from the beach. If we wanted to rent my house out and not have to pay taxes on it for up to 14 days, we could do that. Where it's very popular for our business owner clients is your business can actually rent your home from you for specific business events. You have to charge in line with going market rates, but you can actually do this up to 14 days per year. The business would pay you rent as the homeowner. That's a deduction from the business, and then it's tax-free income to you as the homeowner. And so when we're talking about this to clients, we advise them think along the lines of a marketing event or a networking event, or at the end of the year, if you're gonna host a client appreciation party or an employee appreciation party, instead of renting a private room at a restaurant or renting some ballroom at a hotel, you could host this event in your home. And we regularly see this add up to significant amounts of deductions for our clients. So that's a fun one right there. We'll keep going. Hire your children. Love talking about this one right here. We tend to get a lot of questions on this one, and there tends to be some great information out there, and there tends to be a little bit of confusion too. And so just to highlight a little bit of both, hire your children. You can't hire your children to work in your business. They must perform a role in the business. You have to pay them in line with going market rates. If they do, you can actually pay them up to $14,600 per child per year, tax-free. And so this one can get really interesting right here. We always get the question of, you know, is there an age limit to when the kids can start working there? And because they're your children, the labor laws ages do not apply. So there's not an actual age, but it's got to make sense. It's kind of going back to the points of they've got to be performing a role in the business. You got to pay them in line with going market rates. If you do, You can pay them up to the amount of the standard deduction, which is the $14,600 per year, and they don't need to claim it. They don't need to report it on a tax return. They don't pay any taxes on there. And so what this allows you to do is start income shifting when we're looking at wealth long-term and transitioning things over a long period of time. We want to start to take as much income from you, Mr. or Mrs. Successful Business Owner, who, because you're so successful, you get to pay 37% income taxes on all of your income. We want to start shifting as much of that over to other people that have lower tax brackets. And in this case would be your children that have a 0% tax bracket. And so we get the question a lot of times here of like, oh, can my kid do marketing for the company or modeling or something like that? And just in reality, if you have a 2-year-old, I know they're adorable. I'm sure they're great looking and all that kind of stuff. But if you film one YouTube video or have a picture or two of them on a postcard or a social media post, it's probably not going to justify paying them the full $14,000 per year. In reality, the children are closer to 8, maybe 10 years old. Instead of hiring an outside office administrative person or somebody to book calendar appointments or come clean the office on the weekends, let's look at hiring the children instead and giving them a job, teaching them responsibility, paying them in line with going market rates of what you would pay someone else to do it. But instead of paying that money to an outside source, we're now keeping it in the family, helping you grow that generational wealth there. So that's a really good one. As far as documentation on this one, you want to make sure we've got everything. You're going to need an employee agreement. We're going to need a job description, timesheets, those sort of things, all of which our team can help you out with those. And so that's definitely a fun one right there. And so as we keep going, and we do got some questions coming in here too. Samuel asked, how do you set up your adult children to get on payroll? Basically the same as you would set them up as your children to go on payroll. The biggest difference there is the benefit to paying the younger children is if that's their only income, then it's under that 14,600 amount, then the money is tax-free to them. If you can pay children of any age, or you can essentially have anyone on your payroll that you want, but depending on the overall level of their income for the year, they may or may not pay taxes on it. And so there's a couple differences of ways you can do that. If you're taxed as an S corporation, you're literally just going to set them up as an employee and run them through payroll. If you're set up, this is where some of the magic happens with this kind of stuff, is we can set up a single member LLC as like an outside management company or marketing company, and we wouldn't even need to run them through the payroll. And so it's a great question, Samuel. Hopefully that answers that. If not, I would encourage you to set up an appointment with one of our experts. We're going to put the link in the actual Q&A or in the chat here by the end to be able to go through it, because there are a little bit of differences, and depending on how you are taxed and set up, we want to make sure we handle that the right way. And so, but great question. We got another one here too about, would that apply to an RV if you use it in your business? I'm assuming, great question. It's from Maryland. I'm assuming that's going back to the depreciation, which, yep, RV, it's interesting, right? Because we're seeing this more and more since all the craziness of COVID. A lot of people, moved into RVs, traveling more, doing those sorts of things. Section 179 can apply to an RV. The big thing there is the percentage of business use, percentage of business usage. We want to make sure it's more than 50%. So if you have an RV, we just want to make sure more than 50% of it is used more than 50% of the time, and then it absolutely could qualify for Section 179. So great question. And if anyone else has any questions, please type those in. Like I said, we've got more time built in at the end, but if you have them as we go, feel free to type them in here too. So that's it for hiring your children. After that, last, certainly maybe not the most exciting, but this is very, very important to talk about. We tell people is you got to have good, clean records for this stuff. Every one of the strategies, and these are just sort of the tip of the iceberg strategies that we like to put out there for our clients. There's dozens and dozens of them that will go on, but you got to make sure you have good, clean records for all of them. A lot of this starts with the proper bookkeeping, right? I know it's not exciting to talk about, but one of the reasons you need good bookkeeping is to have a P&L so you can be managing how much money's coming in, how much money's going out. But more importantly, if we're going to start to employ or explore some of these more advanced strategies, we want to make sure they get captured in the books properly. So once they're applied to a tax return, they're not going to raise any red flags or anything like that. And so, a perfect example of this is the Augusta rule. Let's say you qualify for the Augusta rule. You want to have an event in your home. You have the lease agreement between, the business and you personally. Well, when writing the check for the business paying the individual, that should be qualified. That should be inputted as a rent expense in your books. And that's where proper bookkeeping is going to come into play. Similar to having the children on payroll, they're going to either, depending on your entity structure, they're going to either be run through your typical payroll or they're going to be in the subcontractor section. And so implementing these strategies is where the real key to success is here, because nobody wants to have an uncomfortable conversation with the IRS years later. If we do, we want to make sure we have all of our documentation and everything in place. And that starts with proper bookkeeping. So the next one is templates and sample documents available. We've got a lot of this stuff already locked and loaded because we do this with a lot of our clients here. And so if you're interested in any of those strategies specifically, feel free to reach out. We've got templates of the rental agreements. We've got sample documents of employee agreements that you would need if you're going to hire the children for the depreciation expense, all of those different things. We've got plenty of templates and sample documents available to you, which is just part of having those good, clean records. And last but certainly not least, all of this needs to be done in advance, not performed or recreated at the last minute. The time is now for 2024 to save on 2024 taxes. Some of this stuff potentially could maybe apply to 2023 if you're still under extension, but the majority of it is for moving forward. It's all about being proactive in your tax planning and putting a strategy in place now for 2024 to save you money on taxes for this year, and then exponentially moving forward. And so just really understanding that this is all done in advance. It's not performed or recreated at the last minute, especially with the retirement plans. Some of those, kind of like I was saying earlier, we can squeak in the contributions to the plans right at the last minute before the deadlines, but you don't want to be waiting to there. You want to have the plan set up well in advance, understand the calculations, understand the savings, how much you're going to put in there, what it's going to do for you, and just have a good plan for it moving forward. So those are your top 5 tax planning tips of the summer. In conclusion, you need a tax plan. You don't want to wait until the last minute. Book a call with one of our expert advisors. I'm going to put the link to do so in here in the chat in just a minute. Then also everyone will get a follow-up email for joining the webinar here. We're very open to hear your feedback. And if you're an existing client and would love to talk to somebody about your specific situation, we would love to have that conversation with you. If you're a potential client, obviously same thing. We'd love to have a conversation about how we could help you out. Anyone else who joined, we really appreciate you being here. We're going to post that link in the chat in just a second. And then from there, like I promised you, we booked this event for an hour. The content portion of it is usually about 25, 30 minutes, which we're right about there. And so the rest of the time is open for Q&A. So if you have any questions, I would encourage you type them down there in the chat box. I'll stay on for as long as people still have questions and happily answer those. And I always say, if nobody has questions, that means I did such a good job at explaining all this stuff at such a high level and so intuitively that nobody could possibly have any questions for it after that. So thank you guys so much. If you do have questions, pop them in.